With capital planning, you can plan for the short and long-term impact of capital assets, including lease assets, and investments on your financial plans. Capital planning supports International Financial Reporting Standards, IFRS 16, for leased assets, so you can capitalize lease assets and their depreciation, depending on their value, ownership, or tenure, in the balance sheet or in profit and loss. While not an accounting solution, capital planning provides best practice pre-built content, such as drivers, KPIs, and dashboards, and the following capabilities so your planning process supports compliance with IFRS 16 and US GAAP ASC 842. Planning from the lessee point of view. No distinction between operating leases and financial leases. All leases are captured in the balance sheet except those of low value or low tenure. All lease asset depreciation is supported. Provided calculations handle the ownership transfer conditions for depreciation. Lease assets can be indexed to allow for inflation, and low value and tenure lease assets that you define as assumptions don't need to be capitalized and can be captured in profit and loss. You can also plan lease capital assets using the out-of-box 13-period calendar. To get started, select Support for IFRS 16 Standard when you configure your application. This updates the lease calculation rule with IFRS 16 logic. Add assets to the appropriate asset class. You can select any asset class, but here we choose Capital Leased Assets. Then refresh the database. Define your planning and forecasting frequency and granularity to include the time period in which lease payments and depreciation will be populated. Next, define or modify assumptions such as cash flow and funding, depreciation and amortization, and other expense assumptions that drive calculations with the built-in formulas. Here, you can identify assets with low-value lease terms and low values that are charged to profit and loss. Then you can add, modify, remove, convert, and calculate assets. Let's explore some sample ownership use cases. When ownership of an asset stays with the lessor, assets are capitalized in the balance sheet with the net present value of the lease payment. If the lease term is less than useful life, depreciation is charged at lease term. If the lease term is greater than useful life, depreciation is charged at the useful life of the asset. If ownership will be transferred to the lessee, assets are capitalized with the net present value of the lease payment, and depreciation is always charged at the useful life. For a low tenure lease, such as leasing a forklift for less than 12 months, the lease is charged to profit and loss. For a low value lease, such as laptops costing less than $5,000, the lease is charged to profit and loss. You can apply indexation to assets for use in calculations that determine asset value. When you add an asset, you'll specify information such as lease term, payment frequency and timing, interest rate, index rate to include inflation, and ownership after lease term. If you set an index rate, the next period's lease is based on the index of the previous period's lease, which allows for inflation. The Calculate Leased Asset Business Rule takes the index rate amount into account when calculating the net present value of assets. If you don't set an index rate, the lease payments are the same across periods. On the balance sheet, leased assets are calculated as follows. Depreciation is calculated based on the ownership of the lease. Lease payments and net present value are calculated, and lease asset and liability are also calculated. To learn more, visit docs.oracle.com.